Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. Okay, hello, everybody, and welcome back to another week of Wealth Wisdom. Excited to have you guys. It's been an eventful week this week, leading off with the inauguration of President Trump back in office. Bill, let's get into the headlines real quick.
Yeah, big thing is Trump decided to extend the tax cuts that were in place initially in 2018. I think that's a big thing for planning for businesses and individuals going forward. It's nice to have that in place because if for individuals we're speaking to, right, they would have seen a couple percentage points increase in their effective tax rate if we had gone back to the old system. So I think that's really important there. And then I think a couple other things that is good is that the corporate tax rate has been cut, which I know is cut. That's a controversial thing, right? Some people are like, oh, these corporations are getting too big of tax cuts, right? We have all these other issues, but that's gone down. There's going to be, they're going to raise some taxes on companies that do stuff outside of America. So that's something that what they do is they're hoping to incentivize more businesses to be done in America, hopefully thus creating more jobs and more opportunities for people. So I think that's a big thing there. And so we'll see. We'll see what else comes with this. But I think those are the kind of the major points on those tax cuts there. So.
And I think it's already having an effect. I think Stellantis announced 2 days ago this week that they're gonna change plans and open up or reopen some factories in Illinois and Detroit. So
yeah. And I think some of this, the other thing too, is by having some of these tax cuts and more of a push to do this stuff domestically, it's going to put some pressure on some of these other companies or some of these businesses or entities that do stuff outside of the United States. They're going to say, now we get to come with a little bit better deal, right, for Americans, because if we don't, they're not going to do business with us. They're going to keep it more inside the U.S. And so hopefully it will have a butterfly effect, right, on a number of things where it really affects not just businesses being done in America, but it will affect those other countries to hopefully come to the table with a little bit better deal. And so we'll see what comes of it. Hopefully it will.
Yeah, absolutely. Eric, the other huge piece of news was banks profiting huge this week.
Well, let me dive into that. I just want to ask you guys quick.
Ooh.
Are you guys worried about this tax policy pumping up inflation? Is that a concern for you? And what is Trump's plan to counteract that?
I'm not, no. But I want to hear Bill's first.
My word, I'm not. I'm always in favor in things of put more money into the system, like taxes for one thing, right? That's one where I'm always in favor of people keeping that money in their pocket. Will it have some inflation? And listen, anytime you are adding money into the system in any capacity, whether it's taxes, lower rates, anything that goes on like that potential, right, to adds a little fuel to potential inflation. I think it'll be a good thing. It just is. You're always going to have some inflation in a growing economy. There's no way around it.
Right.
You have to have some.
And they have other tools in their tool belt that will hopefully allow them to tame it. You know what I mean? But hopefully some of the things that they're doing will be creating something where everything will be held at bay. You know what I mean? And we'll see growth, but I think it's going to help some of these companies do a lot of they might be able to keep their prices lower. They might be able, you know what I mean? There are things like that'll be really helpful to consumers. It's going to be helpful to the companies. And I think it'll be a net win for everybody. Once you look at all the factors, I think it will be a good thing. And I don't think it will drive up inflation. And again, I think there's other things that they can do to help tame inflation. Taxes is one of them that, I'm always fine with paying a little bit lower and lower in tax. That's not a way where I really want them to be taking money out of the system. So,
What are your thoughts, Eric?
I read that Trump's policy if it does lead to some inflation, the lower corporate tax rate, part of his policy is going to be to strike a deal with OPEC, work with U.S. oil and gas producers, try to keep energy costs as low as possible. That way,
he had a speech about this last night.
Yeah,
he talked about this last night, asking them to reduce prices.
So I had an interesting stat. I thought everyone would find this interesting. So the 1990s, that decade was the second longest economic expansion in the history of the United States. In that time period, the average interest rate for a 30-year fixed mortgage was 8.19%. So right now the average is 7 point something, right?
Yeah.
For a mortgage. The average annual inflation rate was 3.08%. We're actually below that mark right now. So, I mean, I don't know why everyone's like that concerned right now. It seems like if policies stay the way they are, you could you have a chance of having another 1990s happen. So I think that puts it in perspective. We don't have to just look at the period from 09 to 2020 where interest rates were at like 2%. There is an alternative.
Yeah. I do think I agree with that. I think there's going to be a massive boost to GDP in the next few years, whether it happens right this year or in the next 3 or 4 years.
Yeah, Eric, historical, statistical information that is relevant into the conversation, right? That's obviously, it's just funny how, people are always looking at all these different angles and everything like that. And you look back and said, wow, no, this can be done, right? You know what I mean? So, there's always a lot. Every economy has different variables and things like that, right? No two economies are the same. If they were, right, we'd be able to predict things a lot better, right? Than we do. And I think time and time again, it's proven that's very hard to do. But there's a lot of things in place. I think there's a lot of really good things that can happen.
Yeah. I mean, you have energy prices going down. Trump's announcing we're going to be drilling more oil. So we're going to be producing a lot of oil as well. So overall, combine that with what you just said, Eric, I think that's going to be a huge impact on GDP. And then something we haven't really talked about because it's literally, I think it was announced yesterday, but they're talking about a $500 billion investment into American AI companies, right? So trying to make America the AI capital of the world, which, AI could help create better efficiencies for companies and further boost GDP. So pretty optimistic right now.
Yeah, our holdings do really well because of that. A lot of stuff that has to do with the AI centers like Vertiv Holdings and Arista Networks and things along those lines have really benefited from that this past week. So hopefully that trend will continue, right? So
Palantir as well, right? I mean, I think Palantir's going to be poised for a great year ahead.
Yeah, they're back to their all-time high.
So not investing in
it's funny, and that's just one of those stocks where, people keep coming back to that. They say it's over, but
it's like a 350 PE, which is incredibly high.
Very expensive. Yep.
It continues to outperform, and every time they come into an earnings, they seem to not only hit it, but they, exceed it exponentially. So we'll see what the year comes, comes.
I think some investors are turned off too by the fact that a lot of their data is secret as well, so that pushes some people away. But as it gets more mainstream, you could see more money pile in.
Yeah, but you also have to understand though, a lot of these companies they don't want to give that information away. I mean, there's a lot of proprietary information, right? When they're working with companies to build out their AI. It's secretive, and I just don't understand what the alternative. What do you want them to do? You know what I mean? Oh no, we're gonna release all this stuff that we do for people that they have a leg up, whether it's the United States government or it is private corporations, stuff like that. I feel like I'm not sure what the word I'm looking for. It's almost hypocritical for them to what are they going to do? They're going to release all the stuff that they're working on to give these entities a leg up. That doesn't make much sense to me either.
Yeah, for sure. I mean, and next in the headlines, I think the big banks having a heyday right now. Eric, what's the big headline there? JP Morgan Chase, Goldman Sachs, soaring profits.
It's investment banking making a comeback. So JP Morgan's investment banking revenue was up 49% from a year earlier. Also, all these banks are diversified. They have different businesses. So another business JP Morgan has is brokerage trading platforms. So the revenue on that end was also up 29% in the fourth quarter. So that increased market volatility means they're making more money on transactions. Morgan Stanley also saw a 16% bump in investment banking revenue. So their CEO said, we are in the early innings of a multi-year mergers and acquisitions cycle. On the back of that, we should continue to see all kinds of underwriting. So in the new administration, less regulation, you'll see tons more mergers and acquisitions because the government's not going to be blocking those from going through.
Yeah, that's huge.
Yeah, I think
Really
this is a good thing. Yeah, this is definitely a good sign because we definitely saw for obviously coming out of the pandemic, 2023, 22, 23, and early 20, that had really slowed down, right? You know what I mean? Pretty significantly. Almost came to a screeching halt. You know what I mean? I think for the most part. So to start to see this stuff in the second half of 24 and then into 25, I think this is those are some really good signs. And it's happy to see that type of data come to fruition there. And then obviously the expectations going forward that a lot of these CEOs are releasing, that's a good sign, I think, for things to come in this economy.
Yeah. I mean, you'd have to think it's a good barometer for the health of the overall economy. Whereas it's almost like the S&P 500 has not been. Whereas the S&P 500 rallied back to all-time highs, like well ahead of the economic recovery itself. This is a good sign right here.
That's the thing about the market. It's so forward thinking, right? That's why people think, oh, once I start hearing certain things, I'm gonna jump in then, right?
Yeah.
Those little cracks of light, they start coming in earlier than you think, right? It's real dark in the middle of the night, then all of a sudden, boom, like the light starts coming in, and it's tough to jump on it right before that. So it's an important lesson,
absolutely.
With investing.
Yeah. And oftentimes it's hard to be that early because it's maybe at that time it's so contrarian and people are calling you crazy, but sometimes you have to stick to your guns and know, hey, this is going to come out. I think the other thing is
goes against everything your human psychology has done for it. It goes against it, right? Your human psychology. It's tough to do it, but those who do typically get rewarded.
Sure. Yeah, absolutely. The other big news for stocks this week, Netflix had their reportings and they ripped upwards since the reporting on Tuesday. They're up 15%. I think that day was a 9.7% increase just that day alone. But people are excited about this stock. Netflix is doing their thing. Their ad-based tier, more successful than ever expected, and they added 19 million subscribers in the last quarter alone. So I think it's just another example of people, like even just sample size of one. I don't know about you guys at home. Netflix is a go-to when I'm choosing a show to watch. Like, gotta go to Netflix. So I think they're showing a sticky pricing. I wouldn't be surprised if they add price increases as well this year, and they can do it because people aren't going to leave.
I mean, it's a holding of ours. I think we've talked about it several times on this podcast already.
We have.
Definitely a company and a stock that I think we all love, right? And it just continues to do well. I know we'll see, some rumblings about their internal content has not been that great as of late. So I think that's something hopefully that they can improve upon in 25. But from how the company's run to everything they seem to be doing, everything they seem to be doing seems to be working.
And I think, we talked about, we talked about last week or maybe internally how, AI is poised to really help bigger companies first because they have the bandwidth and the spending power to invest in it, right? They have the cash to do it. I think Netflix is one of those companies, right? So you're going to see improvements on their platform because of AI in the short term. I don't know about what you guys think, but
I mean, AI is going to replace writers. It's going to replace the people creating all the animation. It would be huge savings for them. Targeting their users with the best content as well.
I don't think they replace writers. I think it's going to augment them and make them more efficient. Like you got, I don't know what Taylor Sheridan is doing right now. Do you guys watch like Yellowstone, all that stuff? Taylor Sheridan is a writing machine. He's got like 10 shows. They're all top hits. Like,
it is amazing.
I don't know how he's doing it.
Yeah, it's almost like
they're going to take his 10 shows, plug that into AI, generate another show. It's
I don't know, or maybe he's
human creativity.
I don't. Yeah, exactly.
It's not there. Did you see the holiday Coke commercial that was generated by AI?
Yeah, it was terrible.
It was bad. It was bad, but like it shows you what it can
It wasn't.
do.
Yeah.
If like
It was impressive for using all AI. I'll
yeah,
give you that.
yeah, no one touching it. Yeah.
Yeah.
But
But
the
I
AI will get there.
no, but Bill's right. I don't think AI is ever going to replace human creativity. I think it will help augment people to do things that it doesn't require that. It's going to be a shakeup for sure, but I think creativity is something that AI is not going to be very good at.
We'll see.
Yeah.
We'll see.
Eric's a robot. He's like, yeah,
I just don't think people are that creative. Like every artist is basically
what?
steals what someone did before and augments it slightly, which is what AI is going to end up doing.
Time will tell.
That's a very awful outlook, I feel.
Yeah. I actually completely disagree, but we're
Yeah.
going to keep going for the time. The show can only be so long. Although maybe we just jump in a long format like Rogan and just do like 3-hour episodes from now on. So last week on the show, if you guys are listening, we're trying to build on each show. So, but we did talk about, this alarming stat. The average American really only starts saving for retirement around 32, which, if you know anything about compounding, it's best to take full advantage of it. And the longer you're investing, the longer your wealth is going to compound. What Warren Buffett is called compounding, one of the wonders of the world. So we wanted to dive into this topic this week and really help people listening. If you have any family who is younger, a lot of our clients are probably older, but we do have a lot of younger clients as well. And it's never too early to start investing. So, Bill, just so why don't you kick us off? I mean, there's so much here that we can talk about. What's like one of the number one things that you recommend people, at a younger age, what can they do today to really start investing for their future?
Yeah, I think probably the biggest thing that people can do is, I've said this before, I'm going to say it till I'm blue in the face. I'm really just going to pound this in. If you're listening and you're like, oh, here goes Bill on his rant again. Before you do anything, you need to start whatever you're making. You need to almost think of it as I'm making 10, in terms of like my take home income, it's 10% less than what I'm making, right? So if you're looking at a job and you get a job making whatever it is, 50,000, 75,000, 100,000, whatever, you know what I mean? Whatever your job is that you make, 200, I don't care. You're not making 50, you're making 45 take home.
Yeah,
okay. Because 10% off the bat, if you're making 200, you're making 180. You know what I mean? On your take home, you need to do that right from the beginning. It's an expense in a sense, but you're paying yourself first. It is so important. The earlier you do it, you set yourself up so much better if you do it at an early age, especially in your 20s. Where they said that the average person doesn't start till 32.
Yeah.
If you've been doing it from the age of whenever you start working to age 32, you have a leg up on everybody. You know what I mean? Like it almost gets to the point where if you do it earlier, you almost have an opportunity that you could stop saving when you're like 45 or something like that, because you'll do so well with the years of compounding interest. You know what I mean? Whereas on the other end, you have to start doing more, right? So then you have to start being like, oh geez, I need to start saving 15, 20% of my salary later on so that you can have a good retirement. And then you don't have as much expendable income, right? When you want to be spending it, and when you probably have a lot more expenses, right? If you have kids or something like that, right? It's so important to set that up earlier. Like I say, do 10% if you can do more. And if you're worried about, one like little tip I like to give people too is if you're worried about not being able to access it, keep in mind it's advantageous to do a 401k, especially if there's matching, things along those lines, right? There's a couple different other things you can do.
Okay.
You can utilize a brokerage account. Okay. That way you have access to that money. If you do need it, right? You want to have some flexibility. So that's one thing you can do. Another thing you can do that a lot of people don't think of is you can put money into a Roth IRA. Okay. The basis of what you put in, right? So let's say you put in $7,000, right? At a certain age, 23, right? Something like that. Or even whatever, 5,000, right? You say you don't max it out. But then you put in 5,000 every year, and you've done that over 10 years. okay, and say 50,000 that you've put in has now grown to 100,000.
Yep.
If you need to, you can take that 50,000 out, all right? Your basis, your post-tax money that you put in, you can actually take that money out and use that to put down, let's say you need it for a down payment, or you know what I mean, or something like that. There's no penalties, you know what I mean? There's no tax on it, anything like that. You can take that basis out. You've already paid tax on that money, right? And then you can leave the 50,000 that's grown.
Got it.
Right?
Yeah.
If you take that money out, that's where you get hit with penalties and tax, you know what I mean? And tax, all those things on that. So just leave your earnings in. So that's a way to give you some flexibility and not have to pay any taxes in the meantime as well. So those are a couple things that you can be doing. Whereas if you're like, hey, I don't want to get locked into the 401k because what if I need some of this money later on? Those things give you some flexibility on accessing the money. And that's a way to, if you have multiple goals, and there's always variables, right, in people's lives, that's a way to do it as well.
Now,
so
Bill,
I would,
for the
I would
Roth,
say take advantage of them. Yeah.
for the Roth, Bill, are there rules on what you
Say
can
that
use
again,
that
Justin,
basis?
because you're freezing up here.
Oh, sorry. Are there rules? Are there rules for
we
what
lost
you can
Justin,
use the
yeah.
basis for? Am I dead? I lost.
All right.
I
This
think
is
I think
not
I know
good
what
for
Justin's
recording.
trying to ask. He's just asking specifically about the rules for Roth. Like, you're allowed to take out everything you've put in, penalty free,
Yeah.
and then up to 10,000 in earnings, correct? On like a first-time home purchase, right?
For a
I didn't
first
know
time
if there's
home,
any-
yeah, there's exceptions in that manner. Yes,
Yeah.
absolutely. Yeah. But you can take out what you put in.
Yeah.
So that's a thing. Yeah. And then there is obviously, for a first time. So you can use your basis for anything. So there's, you know what I mean? Like literally for anything. So you can take your basis out whenever you want. It's post-tax,
Okay.
Post-tax money, and you take that out first, right? So that's, it's not like a pro rata case or anything like that. You can take that money out first. If you put in, like I said, 5,000 a year over 10 years, you have a basis of 50,000. So whatever that's grown to, I don't care if it's grown to 100 or 120,000, something along those lines, or 90,000, whatever, you can still take out that 50,000. If it's a first time home buyer purchase, you can actually take 10,000 of those earnings out tax free to go towards your down payment, or closing costs or something like that. So it's a nice way of saving for retirement, getting that hopefully what will be tax-free growth into your retirement, right? And at the same and then also accessing it maybe earlier, a little earlier than retirement years for something you may need. If it's something you may need. It's not, ideally, right? You put your contributions in, you leave everything in, but it gives you a little bit more flexibility. So that's one thing just for people to keep in mind.
Right.
Yeah.
But
definitely.
that's in terms of, that's my number one thing. Obviously, you want to keep a diversified portfolio. Remember too, when you're younger, timing of the market does not really mean much to you. You know what I mean? You don't need a sequence of returns. There's not like these other risks, right? You're more concerned about, I would be invested primarily in stock for the most part, upwards of 80+% in the stock market. You want to maximize the rate of return on your investment, and the best place to do that is the stock market. We all realize there's volatility. We all realize there's some things there, but that's when you're young, you can take advantage of that. Market goes down, great, you're buying in at a lower rate. So just keep that automation up, keep that money going in, and that's a very important thing. And Eric, get into why don't you talk about compounding just for a second to give people an example of the power of compounding interest.
Yeah. So $500 monthly starting at age 32. And if you're earning an average annual return of 10%, your investment would compound to 1.5 million by the time you reach age 65. So that's the power of compound interest and the power of starting early, so you have a longer time horizon. And that's assuming, like Bill was talking about, you're invested in the stock market. You got to hit that 10% return, and you might as well when you have this long time horizon. Your safe money is off to the side, or maybe money that you're going to need for a home, something like that. I feel like we hammer the save often. I do want to mention for, young people, you should always also invest in yourself. whether that's like education, because that's only going to help you with your earning potential in the future. And then networking with coworkers. Go out with your coworkers. Don't, go out to the bar with everybody. Don't just save your money all the time. Invest in yourself, invest in the experiences, network with people, and it'll help you in the long run. I feel like oftentimes we're hit on social media with all the stuff we shouldn't spend money on, or stuff we should save. And then the one other thing I wanted to mention, Bill, is the median age for a first-time home buyer right now is 38 years old. And that's why what you mentioned with the Roth IRA is so important. If you can save money in a Roth IRA, you can take out the principal you put in and 10 grand of earnings, put that into your first-time home. Or you could invest in like a brokerage account. And that's a service we provide for our clients. There's also other ways to get into real estate. Like, you don't have to start with your forever home. Start with a smaller condo. Move out of the city. There's tons of options and ways to get in. And if you can't afford a home right now, put it in a retirement account or put it in a brokerage account. Let that build up over time.
Yeah, a great way, I don't know if you can hear me, but a great way to do that, if you're younger, you could buy a multifamily, live in one of the units, and have the other 2 units rented out and subsidize the cost of living, save a little more, still be earning equity in a home. And then either sell that to go into your forever home at some point, or you can keep that possibly depending on your financial situation. But it's a great point. It sounds like I'm back. Maybe you can hear me.
One thing too,
Yeah,
I just want to going back into, sorry, I hate to steal your thunder stat guy, Eric, but you had mentioned that starting at age 32, 500 a month at age 32 leads to a 1.5+ million dollar at age 65. So listen to this. If you start at age 22, same thing, same rate of return. At age 65, 500 a month, starting at age 22, 10% return, 4.283 million at age 65.
Yeah.
4.283 compared to 1.54. Okay. That is astonishing, right?
Yeah.
We're literally talking about $60,000, over 10 years if you put in 500 a month starting at age 22. Okay. $60,000 more is going to lead to an investment return of several $1 million more. Think about what that will do to your retirement. Think about what that will do. You know what I mean? It's the butterfly effect there is just, it's amazing what that does. To start early, it just puts you on it's a different level, right? It's a completely different level. Your retirement will be so different. It might be the point where, hey, you don't even have to, I don't even want to wait till 65 or 67. I want to be able to retire a little earlier. You know what I mean? And think about that. Having the ability to step away from your job, focus on passions, hobbies, spending more time with grandchildren, whatever it is that makes you happier or that you wish you had more time to do, that will allow you to do it. You can do consulting and things like that, maybe at a lower level to keep your professional interest, you know what I mean, still at heart. At the same time, it buys you that extra time to do what you want. Whereas potentially, right, for some people, that 1.5 that may not be enough to support their lifestyle, right? But
either way,
we'll
I just want to plug the website. We have go to foxhillwealth.com. There's a calculators page, and you can click on the compound interest calculator. If you can't do 500 a month, maybe it's 100 a month. Plug that in and see what that'll do for you over time. Once again, it's foxhillwealth.com. Click on the calculators section.
Love that plug. That's a great plug. Just to add on to that, Bill, I think it's massive, and to be able to save. The other day, and this really hit me the other day. Dave Ramsey, and I don't know how you guys feel about him, but he does talk about saving a lot of money, debt-free lifestyle. I don't necessarily agree with the debt-free lifestyle piece. I think there is good debt that you should be fine with, and it's a great way to get to wealth. But he said, hey, great way to blow $5,000 a year is to buy $13 a day of shit you don't need. Stuff you don't need, right? $13 a day. That's it. $13 a day ends up, over 365 days. It's $5,000. And how often at the end of the year, you're like, I have all this stuff. I really didn't need it. Right. So I do think there's something to do with saving. And then the other thing I loved when I was like 21, I read a great book called The Automatic Millionaire by David Bach. And Eric, you talk about this a lot, is automating your savings and investments. Just how do you, so, I won't go into what he says in the book, but, what do you advise clients on automation?
I mean, basically, it forces you to be disciplined, right? When that money's going out, yeah.
But it's easy to do, is my point, right? Like, but talk about how easy it is to do. Like, you can easily set up automatic transfers from, even directly from your payroll setup with your employer to go into separate different accounts, right? So, or you could do it on your banking side alone. You can have, when it hits, you can have that money go into your savings, which then goes into, your Schwab account, etc. Is there any other details I'm missing there?
Oh, yeah. Most employers will allow you to put in up to 3 different banks, right? You know what I mean? Your money. That's in addition to the 401, right? You know what I mean? Or something like that. You could have money going into your 401k, money going into your checking account, money going into a savings account, and really takes it right out of your hands so that you're not, I will.
When you don't see it.
With doing that, right? This is where it comes back. The emergency fund is so important. Okay. Mm-hmm. Because a lot of times what ends up happening, right, when you do the automation is that you go, oh, something happened unexpected this month and you need brakes. I need whatever. I had a higher heating bill, right? Especially if you're living in Massachusetts and it's like single digits every day when you wake up, like it is right now. But so all of a sudden that oil gas bill crept up exponentially and then something comes up. But this is where getting that emergency fund in place, right? Having 3 to 6 months of your salary saved. So that's something that may take some time, right? And when you're in your early 20s, I would say that's something you want to focus on the first, 3 to 5 years that you're working, is you want to, in conjunction with your money that you're saving for retirement, you almost want to think of this emergency savings fund as just being that important as well. Getting that up in place, so that once you do the automation, when those unexpected things come up, what are you doing? You're just dipping into your emergency savings, right? Which then you can replace or fund back over time, but it allows you to borrow from yourself as opposed to borrowing through credit, you know what I mean? And things like that. Keeping away from that high interest debt that is just like having a 800-pound weight on your shoulders, right? You need to stay away from that. It is so you're talking about
especially credit card debt.
Ramsey, you want to hear him talk about credit card debt and stuff like that. The guy, I think
he's spot on when it comes to that.
People to tell them how crazy they are to do those things, and when you say whether you agree with them or not, in terms of things like that, I could not agree with them more. That is, those things you need to stay away from. Leveraging certain debt to help accumulate more cash flow or utilize assets, right? You know what I mean? To hold on to assets so that they're able to grow. That's one thing that I think we're probably a little bit more in favor of, right? So leveraging the debt properly. That high interest debt, you need to stay away from it like it's Ebola. You know what I mean? Like it's the plague. I mean, it's so detrimental. I've seen so many clients struggle with it. It takes a long time to get, you know what I mean? To get back to square one.
Right. And it's hard to get out of a 20% AP.
And when you get setback years, you miss out on those compounding years, right? Yeah. And that's really the thing. That money that could be working for you is now not. Right? It's now not working for you. It's working against you. That's why it's so important to stay away from credit card debt. I cannot stress it enough. It's very detrimental. And that's why establishing those habits early on in your working career are so important. Those strong financial habits. It makes all the difference. It's YOLO,
I think you just
right?
No, I think that's the
once, but you want to live a good life too. And
no, it's important.
Financially responsible. To me, I feel like you can have a much better life. It's all right to splurge, and again, that's why you automate. You have that leftover money, right? You can splurge it, right? You know what I mean? Once you've done the other stuff, right? So you put the other things in place, then you can splurge, and it's no longer a problem for you, right?
Yeah, absolutely. I think I just to highlight that. I think that's the number one. What you just said is so important. Having that discipline, to not YOLO beyond your means.
Yeah.
It's really important.
No, but set up the building blocks.
I wish I talked to you when I was 19, Bill.
Well, you knew me, so you could, you know what I mean? You know what I mean? But I don't know if I was quite thinking about that stuff, you know what I mean, when I was 21 and you were 19, right? You know what I mean? So
Right. No, but I think that's a great spot to end it. If you guys have any questions, as you're listening, shoot us an email. And again,
I'm just laughing as I was blowing money on Bush Light and whatever else, right?
But hey, to Eric's point, it's not necessarily a waste. You probably have an incredible network of friends who were there with you, having those good times too. So I think that is something to consider.
Absolutely.
That's what you hear Prof G of the Prof G podcast always say, move to a
Scott,
city. That's the best investment you can make in yourself when you're young. And that's what he's really talking about, is being around people who are making a lot of money, networking. Yeah, that's it.
Yeah.
Yeah, but you guys can all, everyone listening, you can always email us at hello@foxhillwealth.com. Check out the calculators to help with compound interest and retirement planning.
Play around a little bit. It can be very eye-opening, especially for people. It's funny, in college, man, I was a finance major, so that stuff is second nature to me, and I forget that a lot of people, they've never been exposed to it, right? I mean, it's something that it's so important just to look at and see the power of compounding interest and why it's so important to do it early. And it really is amazing.
It's eye-opening. All right, well, it's another great week. Thank you guys, and thanks to everyone listening.
Okay, take care.
All right, thank you. Have a good one.
All right.